A retail investor bought shares of a company after seeing incredible news. The stock should have exploded upward. Analysts were bullish, revenue was strong, social media was euphoric. But something strange happened. The price barely moved. Then over the next few days, the stock mysteriously drifted downward, while massive trading volume quietly flowed behind the scenes. The investor stared at the screen confused. How is this possible? What he did not know was that a huge percentage of stock trading no longer happens on the public market. Most ordinary investors can actually see. It happens in the shadows, inside something called dark pools. And once you understand how they work, you may never look at the stock market the same way again. If you invest in stocks, comment the word transparency below. Because what you are about to hear explains why millions of ordinary investors feel like the market is secretly working against them, and why some experts believe modern markets are becoming increasingly disconnected from what retail traders think they are seeing. Now, before we go full conspiracy theory, let's establish something important immediately. Dark pools are legal. They were originally created for a legitimate reason. Large institutional investors, pension funds, hedge funds, and asset managers needed a way to buy or sell massive amounts of stock without instantly moving market prices against themselves. Imagine a giant fund trying to buy 20 million shares publicly. The market would instantly notice. Prices would spike upward. The institution would end up paying far more. Dark pools solved this problem by allowing large trades to happen privately before being reported publicly. In theory, that sounds reasonable. But what started as a tool for institutional efficiency has become something far bigger and far more controversial. Today, huge amounts of daily stock trading happen away from public exchanges entirely. Some estimates suggest that roughly 40% or more of US stock trading volume now occurs off exchange through dark pools and internalizers. That means ordinary investors are often reacting to a market that no longer reflects the full picture of supply and demand. And honestly, that is where things start getting disturbing, because markets depend on one critical principle: price discovery. The idea that buyers and sellers openly compete so prices accurately reflect reality. But dark pools reduce transparency. And critics argue that when massive institutional orders happen privately, public prices become less reliable. Think about that carefully. You believe you are seeing the market, but you may only be seeing part of it. And what happens next explains why so many retail investors feel manipulated during volatile trading periods. One Reddit investor described it bluntly: retail investors are basically trading in the kiddie pool, while institutions operate in hidden waters. Now, obviously, Reddit discussions can become emotional and exaggerated, but the frustration itself reveals something important. Retail investors increasingly believe markets favor institutions structurally, and there is evidence supporting at least part of that concern. Because institutional trading firms possess faster technology, superior data, advanced algorithms, privileged infrastructure, and execution advantages ordinary investors simply cannot access. Dark pools amplify that imbalance. And this leads directly to the first major problem. Public markets are supposed to reveal genuine buying and selling pressure, but when enormous trades happen privately, visible prices may no longer reflect actual market demand. One academic paper found that excessive dark pool activity can impair price discovery because information gets absorbed into markets less efficiently. Translation? The real market may be moving underneath the market you can actually see. That creates frustration for retail traders trying to understand price action. A stock may have strong earnings, positive news, heavy interest, and strong retail buying, yet barely move upward. Why? Because large institutional activity may be happening elsewhere entirely. And honestly, this is where ordinary investors begin feeling the game is rigged. Not because dark pools are inherently illegal, but because transparency becomes uneven. Institutions see more, retail sees less. And markets reward information asymmetry brutally. But what happens next is even more controversial. Most retail investors believe when they click buy, their order goes directly to a public exchange. Often, it does not. Many brokerages route retail orders to market makers through systems called Payment for Order Flow, or FOF. One Reddit commenter summarized retail frustration perfectly: "Your order flow is valuable. That's why firms pay for it." And that sentence matters enormously, because ordinary investors often think they are the customer. In reality, their data and order flow may be the product. That realization changes how people view modern markets entirely. And honestly, this is where trust starts breaking down. Because markets rely on confidence. If ordinary investors believe institutions have better information, better speed, hidden liquidity, and structural advantages, then markets stop feeling fair psychologically. And perception matters. A lot. That decision alone has already created enormous anger among retail investors. But the third issue may be the most dangerous of all. Modern markets are increasingly dominated by algorithmic trading systems operating at speeds no human can match. One report estimated that algorithmic and high-frequency trading accounts for the majority of US equity volume. Most people have no idea how technologically unequal modern markets actually became. One financial analyst described modern trading as an arms race, where speed and data access determine advantage. That explains why retail investors increasingly feel, no matter what I do, someone smarter and faster is already ahead of me. Because in many cases, that may literally be true. But now comes the important part most emotional anti-market videos completely ignore. Dark pools are not automatically evil. And the market is not secretly controlled by one mastermind organization manipulating every trade. Because millions of ordinary people indirectly benefit from institutional efficiency through retirement funds. The problem is not simply that dark pools exist. The problem is opacity. And opacity creates distrust, especially during periods of volatility. And this is where market psychology becomes dangerous. When people lose trust in fairness, they become emotional. That leads to conspiracy thinking, panic trading, meme stock speculation, and extreme narratives. The GameStop frenzy revealed this perfectly. Millions of retail traders became convinced institutions were manipulating markets against them. And institutional infrastructure operating at unbelievable scale. Two completely different worlds. And that creates a dangerous illusion. Retail investors think markets are simple. They are not. Modern markets resemble technological battlefields, and this leads to the most important question of all. If markets are structurally unequal, how can ordinary investors still win? The answer is surprisingly simple. Stop trying to compete on speed. Institutions dominate short-term trading, microsecond execution, and information flow. Retail investors usually lose trying to beat machines at their own game, but long-term investing changes the battlefield entirely. One Reddit commenter said something incredibly important: the market is hardest on impatient people. That sentence explains why long-term investors often outperform emotional traders despite institutional advantages. But investors focused on diversification, long-term ownership, cash flow, and patience operate on a completely different timeline. And that timeline is harder for algorithms to exploit emotionally. There is another important truth most people never hear. The market does not need to be perfectly fair to still create wealth. It only needs to reward discipline over time. And historically, disciplined long-term investors still built enormous wealth despite crashes, manipulation fears, institutional advantages, and technological inequality. The key is understanding the game you are actually playing. If you think markets are perfectly fair, you are naive. If you think markets are completely fake and impossible to win in, you are also wrong. Reality exists in the uncomfortable middle. Institutions absolutely possess structural advantages. Institutions know ordinary investors panic during crashes, during uncertainty, during volatility, and during confusion. And markets punish emotional behavior brutally. That has always been true. Dark pools simply made the battlefield more complicated, not unwinnable.